Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with the weekly economic review, this time for the week ending March 28, 2024. We're just about to close the door on Q1, so I propose that we're looking back today on a very interesting quarter. So three teams were very dominant, I would say, in the first quarter. We talked a lot about technology, NVIDIA, artificial intelligence, but so when you look at the markets, you might think that, well, this is pretty much all about tech, but no, there's good news when you look under the hood. Breadth is widening, so that would be one. After that, we'll look at economic data, which continues to surprise globally, not so much in Canada, but this is leading to upward revisions for forecasts for growth in 2024. And finally, we'll talk again about the Fed, how the Fed, the expectations for the number of rate cuts this year has been a dominant theme also in Q1 and should continue to be a dominant theme looking forward. So when we look at the returns this week at the close on Wednesday, because I'm recording this on a Thursday morning, if you look the columns on the left for the week, you see that it was a positive week for bonds, rates slightly lower. For equities in local currency, pretty much overall positive. In Canadian dollar, more negative globally, mostly because the Canadian dollar was stronger versus the USD, or rather we can say that USD was weaker against pretty much everything on the week. Price of oil higher, euro higher, Canadian dollar higher, price of gold higher. So this is the topic, the picture for the week, not very eventful on the macro front. When we look year to date, so this is where I want to focus today. So after one quarter, still negative for bonds. This is what you see on the top right of the table. If you go to the equities section on the right, you see that there's an interesting story here. There are multiple interesting stories. In local currency, 6.3% for the TSX, lagging the US, which returned about 10%, but still a very decent return for Q1 for the TSX. EFI up 10%, emerging markets lagging, but still positive at 3.8. Now again, you might look at this and say, well, technology, of course, was all over this. You're not wrong, but there's other stories that are brewing under the hood. So if you just look at the sectors, communication sector was number one for the S&P 500 in Q1, 15% return. Of course, Meta or Facebook was all over this with a very strong performance year to date. Information technology was number two with 13% return, again for the S&P 500. But number three, you have head-to-head financials and energy, 11.5%. Each. So you're starting to see cyclicals participate. This is the message here. We're seeing more breadth and more leadership within the stock market, which is very good news for the continuation of this upward move in equities. TSX, also very interesting stories under the hood. You have 6.3% return year to date, but if you look at sectors, it's healthcare, 18%. After that, number two, head-to-head, industrials and energy with 11% each. So good news, breadth is always important when you have these up moves, and we're seeing breadth widening, which announces good things for things to come. It's not so concentrated within just one sector, a few names, as we were worried for parts of 2023. Looking at economic data now. So what we've seen throughout the quarter was that economic surprises were getting better globally. If you look at Canada, to pretty much the reverse story. So if you look at the chart on the left, the red line on the bottom is Canada. So economic data came in below expectations throughout the quarter. If you look at the US, you look at China, you look at Euro area, we've seen positive surprises throughout the quarter. So we're seeing some economic momentum in the leaders of global economic growth. Good news there. And of course, that leads economists, investors to revise higher their expectations for growth. This is what we see on the right. Expectations for US GDP in 2024 for GDP growth went from below 1.5% to now 2.2%. So very strong upward revisions in the US. And interestingly, even though Canada had negative surprises, of course, given the strength of the economic relationship with the US, if you revise the US higher, at some point you need to revise Canada's growth higher too. So the risks of recession in 2024, they pretty much disappeared from the radar here. So good news here. And of course, this is sustaining the move higher in equities with a higher expected earnings growth. Looking at the Fed now, expectations towards the Fed for the rest of the year were revised higher during the year. Higher, that means fewer cuts. This is what we see on the chart on the left here. If you focus on the darker line on the bottom left of your screen, we went from expecting, investors went from investing 6 cuts by the end of the year. We were skeptic on that. We thought it was too much. Now it's 3 cuts, which we feel is more reasonable. But this is still a live question. We remember last week we discussed Mr. Powell's press conference at the latest decision of the Fed, where he seemed eager to get going with rate cuts, maybe before the window of the elections makes life difficult for the Fed to start to move higher or lower. Typically, they tend to start moving before and continue throughout, or wait after the election. This is kind of the stylized facts of how the Fed behaves around elections. Now, we were skeptical last week that they could or they should start doing that this summer, because inflation seems to be reaccelerating. Well, we're not alone. We have other Fed regional presidents, like here it's Mr. Waller, that opined this week that maybe there's no rush, maybe they should wait, maybe they should be patient. So this is starting to point towards maybe we'll have cuts that could be after the election or at the end of the year. So if we have a scenario where economic growth is accelerating, inflation is reaccelerating, and the Fed starts cutting in June, of course, this is very positive for risk appetite because you have nominal growth and lower interest rates. So this could be very positive for gold. We'll mention that. We'll discuss that in a few minutes. If we wait until the end of the year because growth is strong, inflation is reaccelerating, and they're not talking about hiking rates again. These are all our environments that should be beneficial to earnings growth and also to stock market valuations, pushing valuations higher. So what's happening here is always the why that counts. And if the Fed waits because the economy is getting stronger, again, there's good news here for equities. If you look at price of gold now, price of gold has been very interesting of late. What is it telling us? Well, it's starting when we look at the price of gold, which has been strong over the last month or so, about 10% higher. We see that it's kind of sniffing more uncertainty on interest rates, more uncertainty on monetary policy, more uncertainty on inflation, and also the scenario where inflation reaccelerates and the Fed still starts cutting. This is pretty much a Goldilocks scenario for the price of gold. So this has been one of our tactical views for a good while. We still hold a positive view on gold. We added some in our portfolios, and we're listening to the message that gold is telling us that more uncertainty ahead around inflation. So it could be this is a good hedge to have within a portfolio. So Q1 was interesting. Now, if you look forward at Q2, well, the themes will still be economic growth, or we're going to see more upward revision. Is inflation really reaccelerating, or did we just have a bump in the road early in the year? And of course, for a stock market, recent breadth, will that continue to push equities higher? Those will be the important themes of Q2. So what we'll be watching next week, we'll look at the Canadian economy. Recently, data has been lackluster. We'll have a new reading, the Business Outlook Survey from the Bank of Canada. The survey has been net negative since early 2023, so we'll see if businesses continue to be downbeat about the economy. We'll have the employment report, 38,000 jobs created. Used to be a strong number, but now population growth is so strong that this is not keeping up with population growth. Unemployment rate should thus remain high at 5.8%. In the US, we'll have a reading on manufacturing and services, and also the job report. Job report in the US continues to be strong. Unemployment rate is seen as falling rather than rising. So again, one more argument for the Fed to be careful before getting moving with rate cuts. So that wraps it up for the week. Always a pleasure to serve you, and I'll be back again next week.